What if I told you $2 a day, literally the price of a coffee, builds $1,000 a month in passive income? Not in 5 years. Not in 10. But in 30, and the math is real. Today I'm showing you 3 daily amounts. $2, $6, and $18. Each one unlocks a different income level. $1,000, $3,000, and $10,000 a month. Every single month. For life. But here's what your bank, your advisor, and most finance channels won't tell you. The investment everyone tells you to buy? It barely pays you anything anymore. I'm Subhan. And in this video I'll show you exactly how to build real dividend income starting from almost nothing. Let's get into it. The S&P problem. Let's start with the uncomfortable truth. For nearly 100 years, the S&P 500 paid investors to own it. Dividend yield sat above 3%, sometimes 4%. Today? That yield is 1.1%. The lowest it has ever been in modern market history. Put $100,000 into the S&P 500 right now. The dividends pay you $90 a month. That's not income. That's barely a coffee budget. Want $1,000 a month from the S&P? You need $1.09 million sitting there first. $3,000 a month? $3.27 million. $10,000 a month? Nearly $11 million. Nobody has $11 million sitting around. So what do regular people actually do? You use the one thing everyone has access to. Time. How compounding works. Let me show you how this actually builds, with simple numbers. You put $1,000 into a stock. $5 a share. 5% dividend yield. That gives you 200 shares. Year 1, those shares pay you $50. You don't cash it out. You reinvest it. Buy 10 more shares. Year 2, now you have 210 shares. They pay $52.50. Reinvest again. 10 more shares. Year 3, 231 shares. Dividend, $55. Growing. And you haven't added a single dollar. Now here's what makes good ETFs different from this example. In real life? Both the share price and the dividend grow. That's 2 engines running at the same time. That's how $2 a day becomes $1,000 a month. The ETF selection framework. But not every dividend ETF deserves your money. Here's the exact 3-part filter I use to pick them. Number 1, expense ratio. This is what the fund charges you every year just to hold it. Over 30 years, a high fee quietly eats thousands from your dividend income. For broad US funds, stay well under 0.1%. Number 2, what does the fund actually screen for? Some funds chase high yield. That sounds great. It usually isn't. High yield often means a company with serious problems. You want funds screening for dividend quality, yield, growth, and consistency. Number 3, track record. A fund that's been running 3 years can't prove anything. You want at least 10 years of dividend history through real market crashes. 5 ETFs pass all 3 of these filters. Let's go through them. The 5 ETFs. First, SCHD. Schwab US Dividend Equity ETF. This is the foundation of the entire portfolio. 105 of the strongest dividend-paying companies in America. Yield, 3.39%. Dividend growth, 10.4% per year. Expense ratio, just 0.06%. Second, SDY. Every company in this fund has raised its dividend for 20 consecutive years. Through 2008. Through COVID. Every year. Raised. Yield, 2.49%. Dividend growth, 6.2% per year. Third, DGRO. Broader exposure than SCHD. Highest share price appreciation of any fund in this portfolio, 10.4% annually. Expense ratio, 0.08%. Fourth, FNDF. This is the international piece. Most global ETFs weight by market cap. This one weights by fundamentals, sales, cash flow, dividends. Yield, 3.05%. Dividend growth, 12.1% per year. Fifth, INTF. The exception to the 10-year rule. It's only been around since 2015. But its dividend has grown 18.2% per year. That number earned its spot in the portfolio. Blend all 5 equally. Combined yield, 2.72%. Dividend growth rate, 11.18% per year. That combination does the heavy lifting over 3 decades. The 3 tiers, 5 to 7 o'clock. Tier 1. $1,000 a month. Daily investment, $2. Price of a pack of gum. Year 10, portfolio sits at $12,219. Monthly dividend, $32. Looks small. Don't stop. Year 20, $51,614 in the account. Monthly dividend, $198. The portfolio now pays out more per year than 3 times what you're putting in. Year 30, portfolio reaches $206,694. Monthly dividend, $1,113. Every month. For life. You put in $21,900. The market added $184,000. Tier 2. $3,000 a month. Daily investment, $6. The price of a fast food lunch. Same 5 funds. Same 30 years. Portfolio reaches $620,000. Monthly dividend, $3,340. You put in $65,700. The market added $554,000. $247,000 of that came from reinvested dividends alone. And now the top tier. $10,000 a month. Daily investment, just $18. 2 coffees and a snack. Year 10, $109,967 in the portfolio. $288 a month in dividends. Most people see this and quit. This is the exact moment 99% of investors walk away. And it's the biggest financial mistake they ever make. Year 20, $464,524 in the account. Monthly dividend, $1,782. The portfolio is now paying you more per month than you're putting in. Year 30, $1,860,249. Monthly dividend, $10,020. Every single month. For the rest of your life. You contributed $197,100. The market built the other $1.66 million. $743,000 of that, from reinvested dividends. Let's put all 3 side by side. $2 a day $206,000 portfolio $1,113 per month. $6 a day $620,000 portfolio $3,340 per month. $18 a day $1.86 million portfolio $10,020 per month. Same 5 funds. Same Roth IRA. The only variable is time. Time is the real investment. But what if you don't have 30 years? What if you're starting at 40 or 50? I ran the math on 10 and 20-year timelines too. And the monthly number you'd need is not what most people guess. That video is coming next. Hit subscribe so you don't miss it. And drop in the comments, which tier are you building toward? $1,000, $3,000, or $10,000? I'm Subhan. See you in the next one.